take a look at a very topical subject, insider dealing. As the SEC launches another huge case, we need to look at what is insider dealing, how do people get caught, and what are the consequences. So, insider dealing. Now, as the name suggests, some kind of insiders involved, and there's some kind of trading going on. So here's a little scenario. Let's imagine you have a company director of firm ABC. So a company director, and this director has the results announcement due to be released in 2 days' time to the market through, let's say, the London Stock Exchange. And that results announcement is going to hammer the share price because it's bad news. The company's not doing as well as everybody currently thinks. So he's got this results announcement early. He's a director after all. So in a phone conversation with his mate, a hedge fund manager, he lets slip that the results are not going to be terribly good in 2 days' time. And that conversation takes place over the phone. The hedge fund manager then has a beer with his lawyer that afternoon, late lunch, and lets slip to his lawyer that actually ABC's results, released in 2 days' time to the general public and the market, not looking too good. That lawyer goes home and tells his wife over supper that ABC's results announcement coming up soon, a couple of days' time, isn't going to be too good. And the next day, ahead of the results announcement, she sells all her ABC shares. Who could be nailed for insider dealing? Probably guess the answer, all of them. So what is insider dealing? And how could it potentially catch so many people? Well, let's go through a few pointers first of all. Number one, under UK law, you need to have an insider involved. Now, insiders, people often think, are directors of companies. After all, they're the kind of people that have access to information about firms and results announcements and new deals that other people don't. But actually, insiders can be much more than just company directors. Yes, of course, company directors are insiders, but so are what the law calls knowing tippees. Odd expression in the UK. Essentially, an insider, company directors are all insiders. They have access to information that other people don't, and they should keep it to themselves. Why? Because by releasing it early, they allow other people a kind of competitive advantage, if you like, and that's deemed not fair. Markets are supposed to be fair. Everybody gets information at roughly the same time. But the point is, a knowing tippee is anybody that an insider passes confidential, price-sensitive information on to. So it could be the hedge fund manager. It could be the lawyer, a professional advisor. It could be the wife of the hedge fund manager. In other words, anyone can potentially be a knowing tippee. If a mate of yours grabs you in the pub and says, do you know what, I've just heard something from a friend of mine, he's a company director, he's passed on a bit of information that no one else knows, you want to do something about it tomorrow, get rid of your shares, or even buy some shares if it's good news, you are now an insider too. So the net is cast very wide. The problem, of course, for prosecutors, if all these people are insiders, is how you prove it. More about that in a moment. So, we need an insider, and in my example, we certainly had one, a company director, but actually we had a whole string of them. Now, next thing we need is the right sort of information. Price-sensitive information. In other words, the information that an insider passes on for it to be illegal needs to be information that will in some way affect the share price. So normally, it's what one prosecutor has called tomorrow's information today. So, for example, companies are supposed to release information that could affect the share price at the same time through regulatory news feeds on stock exchanges. That is meant to try and ensure that all investors have access to it and can react at the same time. Because obviously if one investor knows early, they'll react first, and that's unfair. So, price-sensitive information is information that's capable of moving the share price up or down. A lot of people think that an insider dealer is someone who gets information about good news early, buys the shares and makes a profit. True. But it's also, in my example, somebody who gets bad news early and dumps all their shares to avoid a loss. They're both dodgy in the eyes of the law. Now, having an insider, a company director with price-sensitive information, so what? Something's got to happen to make it insider dealing. So the third test is a deal. Now, a lot of people think, well, that's all right. I mean, the only person who dealt in my example was the wife, right down the end of the chain. So I can see she's sort of guilty somehow, but the others aren't. Well, they are. Because, yeah, if you buy or sell shares with inside information, yeah, you've committed the most obvious form of the crime. But simply passing information on where you know that it's inside information is also illegal. It's more difficult to prove, because obviously there are records of deals, but nonetheless, it's illegal. So everybody in my chain potentially is an insider dealer. Right. Next question, I suppose, is defences. So someone's accusing me of insider dealing. I'm a company director. The usual one that's played these days is, well, yes, I'm a director of a company. Of course I have access to inside information. I'm a director. All my fellow directors have that information too. And that in itself isn't a problem. True. I even pass on the information, but I did it in the normal course of business. You know, one director telling another director about the latest results announcement ahead of the results announcement, not a problem. It's their job. You can't, as a director, keep everything to yourself. You have to share it with your fellow board members. That's not insider trading. But passing the same information on to an outsider, like a hedge fund manager, that's different. Whether that falls under the usual or normal course of business is much more debatable. You can't simply tip people advanced information because you like them or you owe them a favour. You might say you can, because all's fair in love and war and in the financial markets jungle, but you're breaking the law. Okay, so there are one or two other defences, but the main one is usually, well, yes, I'm an insider, it was price-sensitive information, yeah, I passed it on, but within the normal course of doing my job. Okay, what if that doesn't work? Insider dealing as a crime carries criminal penalties, so big fines and prison sentences. Which then begs the next question. If insider dealing is a crime, and although there's been a rush of prosecutions recently in the wake of the financial crisis, why aren't more people nailed for it? And the answer is that a jury needs to be persuaded in this country beyond reasonable doubt that an insider has committed a crime. That's the standard criminal test. Because crimes carry big penalties, including prison, the bar is set quite high, and it's a jury that decides. It's not, one hedge fund manager's opinion against another. It's a jury drawn from the population. And beyond reasonable doubt, in a complicated insider dealing case with networks of information, phone conversations, emails, tricky deals, it can all get quite difficult to persuade a jury as a prosecutor beyond reasonable doubt that an insider deal has taken place. And of course, the defence will do their best to argue that, well, it's a victimless crime. My client did nothing other than carry out their job. So, that's why there are not as many prosecutions as there might be, because a jury has to understand the full facts of the case and then persuade itself beyond reasonable doubt that insider dealing's taken place. Okay, so to finish this video, because of that, in the UK, the regulator, the Financial Services Authority, has some extra powers under the market abuse rules. Essentially what they can do is they can try and embarrass an insider even if they can't prosecute them. This is basically the regulator, not a jury, saying, on a balance of probabilities, 50-50 confident, we think some sort of market abuse, insider dealing type activity has taken place. Because we're not a judge and jury, as a regulator we can't send this person to prison, but we can, at the very least, name and shame them. And that fills in some of the gaps created by the difficulty sometimes of landing big insider dealing cases.